is stablecoin going to destabilize modern banking as we know it? We have been having endless discussions on how stablecoin is better in every way compared to the prevalent banking infrastructure that we have today. Now, as a crypto guy, I have never really had any formal education on banking. I don't really know in depth how the modern banking infrastructure works, but from what I have seen and what I have experienced, I know the system sucks. It's slower, it's more difficult, complex than it should be, at least in this day and age. So I wanted to learn more about it. I did some digging.
So what
Uh,
exactly did you find? Is it bad?
oh yeah, it's worse than I imagined. So let me go one by one through all the wonderful things that I have uncovered about this wonderful infrastructure that we have, and why you should absolutely obliterate this system and create something that actually works.
Mm.
Let's start with the Swift system. In the very beginning, I want to actually to bust this myth that Swift is the modern banking infrastructure. It's not. Swift is just the messaging infrastructure that the banking infrastructure has on top of it. Swift is how banks talk between each other. That's all. That's all Swift is for. The actual settlement happens deep down under through a myriad of other systems that I will go through. In general, let me just give you what Swift does. Actually, let's start with what Swift means, right? So it's the
Mhm.
Society for Worldwide Interbank Financial Telecommunication. A super long name, just as
Yeah.
system is. Now it's about like there are 11,000 financial institutions in the system. About 200 countries communicate payment instructions through over Swift, and
Hmm.
so here's how Swift works, right? When a bank in one country needs to make a payment for a client to a beneficiary at a different bank in another country, and let's say the two banks don't have a direct relationship, which most banks obviously don't, because there are
Right.
thousands of banks and you cannot be partnered with every single one of them. So what happens is you rely on a chain of communication through intermediaries. These intermediaries are called correspondent banks, and this entire system is called correspondent banking system. So the originating bank sends a Swift message to its correspondent bank, which may in turn forward the message to the next one in chain, which is let's say another corresponding bank, and the message goes on from like hops from one bank to another bank. Finally, it reaches the beneficiary bank at the end, right? And so, how does that
Hmm.
this work exactly? I understand that these banks are sending messages through each other. Now, how does this work in monetary terms, right? So to understand how this actual settlement takes place, you need to understand what Nostro and Vostro accounts are. Nostro in Latin means ours, and Vostro in Latin means yours. Pretty simple, right? So, for
Right.
example, let's say a Nostro account is a bank's record of its money held in deposit at another bank. So, let's say a German bank, for example, Deutsche, has its USD denominated account held at a US bank. For example, let's say Bank of America. So that Bank of America account will be Deutsches Nostro account. And from a different
Uh,
perspective, for Bank of America, the Deutsches Nostro account will be its Vostro account because it's holding money for Deutsche. And when settlement occurs, the correspondent bank receives the Swift instruction that says
hmm.
like, hey, I am sending money through you, so you need to debit the money from my Nostro account that I have with you, and you pay
Uh-huh.
it forward to your next correspondent bank in the chain. And this is what you also call pre-funded liquidity. The liquidity already exists. You just take it and use it when you need to. So this is the general infrastructure of how the Swift messaging system works, right? So banks will talk to each other through the cover method, and once the settlement is done, you get your money at the end of the transaction. So this is
What's covered?
okay. So yeah, that's actually a good question. Let me explain what cover is. So the Swift generally has two types of messaging system. One is the serial method. The other one is the cover method. Let me just answer what a cover is, because serial is just a
Mhm.
primitive version of a cover. So, for example, when let's say customer A wants to initiate a transaction, what they will do is they will go to their bank, or they will basically take out their phone and initiate the transaction. The
Mhm.
first thing that happens is the Swift system from bank A. Let's say the customer is at bank A and the receiver, the beneficiary, is at bank D. So bank A will send a message to bank D saying, please credit your customers, funds are coming via cover. So this is basically an advanced intimation that you get. Now, actually, I have a diagram for this. Let me share my screen so we can get a better understanding. Yeah. So as you can see here, this is a 4-step system. The first one is, as I said, it's the heads up. So bank A sends M2103, which is a technical term for the message, to the beneficiary bank at B. The message says, basically, get ready to pay your customer. We are sending the actual funds through our partner's banks to cover this instruction. Now, at the second phase, bank A tells its own partner bank, let's say at bank B, to send the money to bank D through its partner at bank C, which means is bank A and bank D are not directly related. So they have to go through bank A goes to bank B, bank B credits its Nostro account, credits its Vostro account of bank A, and sends the fund forward to bank C, which does the same thing, which finally reaches bank D, and then bank D deducts and credits the beneficiary at the end, right? And that's where the settlement takes place. And once the final credit is done, the whole thing is cleared and the transaction is settled. That's pretty much what
So is it called cover because the second message is literally meant to cover the first message?
Yeah, you can say so. Like it's the transaction is getting covered and it's coming through the bank, like our chain of correspondent banks. So this is basically the system of how a same currency transaction takes place. So in a multi-currency transaction, the system will be slightly more different and a bit more.
And what's the difference here for multi-currency transactions?
For multi-currency, the foreign exchange part comes into place. So you have to add this FX leg, which is actually adds a lot of complexity. I downplayed it by saying slightly more complex. So for example, let me just answer the first part first, and then I will go a bit deeper into it. Let's say you are sending euro to a person who wants it to be credited in USD. Let's say you're buying something in USD, $100, and you want to pay it in euro, right? So what happens exactly?
Right.
The receiver bank needs to get paid in USD, but you don't have USD, you have got euro. So that means there has to be an intermediary who buys the euro from you, converts it into USD, and pays it to the customer. And this is where the CLS system comes into place, actually. So a CLS system will be it's the full form will be continuous linked settlement. It's sort of an escrow system for customers that are doing an FX trade. So it's a specialized interbank settlement system, you can say. The main reason the settlement system or the CLS system actually exists is to make sure that the both legs of the transaction settle at the same time. Now, what does that mean, that both legs has to settle at the same time? For foreign exchange transactions, you need to be aware of a few risks that are present in the system. So there's this risk called the Herstatt risk, where one party makes the payment and the other party simply does not make the payment for whatever reason, let's say, or does not make the payment in the at the moment when it needs to be done for time zone differences or something else. Or this is also known as the payment versus payment system, which introduces this risk. And you need to
also I would like to add a fun fact for the audience. It's actually called Herstatt Risk because it's named after a German bank that failed in 1974.
Oh, really? I did not know that.
Yes.
I mean, I thought Herstatt
That's what
was
the
an
name comes
economist who came up with it. Okay, this is not a dude. This is a bank. That's good to know. Yeah. Okay. So let me actually. This is getting a bit complicated. So let me actually give you an example.
Yeah.
So as you said German, so I will just go with use Germany the example. So let's say you are in Germany and you have got some euro and you want to buy a subscription that costs about $100, right? So you go to your bank, let's say Bank A in Germany. Bank A says, sure, I will debit your euro and arrange USD like $100 to the merchant bank at the bank D. It's in dollars, so let's say the US, right? Now, what happens is, obviously, like, this bank in Germany does not have USD lying around in its home branch, so it needs to buy USD from someone else. So from another bank, say Bank B, that in exchange for the euro. So this is the foreign exchange trade. So you are selling euro to buy some USD to send to another bank. Now, here's the problem. Without the CLS system, Bank A might send euro to Bank B, let's say using the RTGS system. and hours later, Bank B is supposed to send USD via something like the Fed wire or the chip system. Now, if Bank B defaults or it fails to pay the money
Ah,
at the right time, then Bank A has lost its euro because it has already sent the euro, and Bank B hasn't returned with the dollar. So that means Bank
and
A has
that's the Herstatt risk, right?
yes, exactly. That's the Herstatt risk. So this is how the CLS system fixes it. Imagine like the CLS system works in sort of like an escrow system. It will take the euro from bank A and it will also take the USD from bank B and it will hold it. And once both parties have paid into the CLS system, they will CLS system will
Okay.
release it. So bank A gets its USD and bank B gets its euro.
It
And
almost acts like a referee or a middleman.
yeah, exactly. That's exactly what it does. And for now, the CLS system has about 18 currencies that it offers direct support to. And
Mhm.
if you are not for part of these 18 currencies, then you are simply using a correspondent bank that has access to the CLS system.
Oh.
And that's basically how it works. Now, yeah, pretty much this is the entire system. No, actually, missed the system where, the for foreign exchange trade has settled. Now it simply follows the general transaction where from one bank to another bank it hops until it reaches your target bank, right? And that's the transaction gets settled there, and that's pretty much it. Now, yeah, so this is the general infrastructure how the entire Swift banking system works, right? Now, what's wrong with it? Why is Swift bad? And if you haven't got some ideas with like from the beginning
You've
to
talked enough, right?
yeah, like there are plenty of problems. Let's try to list them one by one. First of all, latency. Messages like
Mm.
Swift is instant. Like sending a message, it's not there is no delay, unnecessary delay.
It's not exactly the settlement of money, but more of a messaging system.
Yeah, exactly. So like if you're sending a message, it's instant, but the problem is the money doesn't follow the same speed as the message itself.
Mhm.
So imagine like it's the weekends, it's the holidays, there's a time zone difference.
Right.
You can easily have a 24 to 48 hour difference between a payment. Adding this adding to the delay, you have got multiple banks that are a part of the transaction. That means every
Mhm.
single bank does its own verification, does its own screening, and
Um,
they create multiple points of failures, multiple possible points of failure, let's say. And if there is a possibility of failure, then it's bound to happen at some point, right? Now, what happens when a transaction fails? That means, or let's say repayment is delayed. What happens then exactly? So you have to create a manual tracing request, which costs money, is not free. Like my transaction has failed. Why has it failed? To know that I have to pay you, to know how exactly you have failed. Now, so they suck at having like enough resources and enough data to tell you exactly what went wrong at what stage. So it's finding like a needle in a haystack. So the time to finality issue is one of the biggest one, and then you have also got something like limited programmability. Like the system works how it works. You cannot do something new with it. You cannot innovate. You cannot experiment with the system. It's exactly how it works, and that's it. So you have to like it's not like the blockchain. It's not like the blockchain infrastructure where everything is composable and there is some way you can innovate every single time, right?
mhm.
And then everything every single steps makes a transaction more and more expensive, right?
What about fees? Why is it so expensive?
Oh yeah, like I forgot about fees. So as there however many intermediaries there are, every single one of them will charge you some amount of money. So the center bank that's sending the money will charge you something. Then there are intermediaries, so per hop there is a lifting fee that
Mhm.
will be deducted. And then obviously you have got the foreign exchange fee, which is one of the biggest ones.
Uh,
In some cases the FX fee will be at 2 to 4% of the entire transaction amount. So the World Bank did this a study. uh, I think it was just last month actually, the August of 2025. This report came back that on a $200 remittance, the average fee was 6.49%. So you are losing 6.5% of $200, which is like $13 or $14 to
mhm.
fees. Imagine that. How can
Right.
the system be sustainable when it's charging so much money when it's so slow, there are so many intermediaries, and so there are so many possible points of failures, right?
And again, for the failure, to know the failure as well, you have to pay fees.
Oh yeah, yeah, exactly. So even to know what has gone wrong, you have to pay. Uh, it's just a complete caricature of itself at this point. Now, one thing that I want to mention is that again, Swift is not the enemy here. Swift has obviously it's a system from the 1970s, 1980s, and it has tried to keep up with times. It has tried to update itself through something like this, like ISO 222. I don't know how you say it, 20022 update that they did recently. They have updated with the system called GPIs. So they have tried to keep up with times and with financial innovation. But the thing is, it doesn't matter how polished a 2,000-year-old infrastructure looks. At the end of the day, it's a brittle, it's a fragile system. But where we make the mistake is we think that Swift is the banking infrastructure. It's not, right? Swift is basically the messenger of an inefficient process. For stablecoins need to directly attack the correspondent banking business model. That's pretty much it. That's where all the profit of this banking industry comes from. And stablecoin will easily be able to replace it in a very short period of time.
Is what you're saying is that stablecoin will allow us to send the money and the message at the same time?
Yes, exactly. I mean, yeah, that's what it's going to do. Because again, for Swift, the message goes first, the money goes then. For stablecoin, the money and the message is only one transaction. So yeah, the money and message goes at the same time. What else can stablecoin do? That's much better than the Swift infrastructure, the banking infrastructure that we have. It's obviously like 24/7 finality. There is no cutoffs, no weekends. Every transactions gets settled in seconds, and everything is extremely programmable. So you can have escrows, you can have conditional release, you can have automated reconciliations and bulk disbursements, all of it however you want it to, right? And then fees are extremely minimal. The funny thing is, like, even for fees outside of the gas fees that the blockchain needs, everything else is your on ramp and off ramp fees. That has nothing to do with the blockchain. It has to do with the fintech company that's providing the service. So with enough competition, the fees will go to below 1%. That's for sure. So yeah, what cannot stablecoins magically fix? It cannot fix the on and off ramp issues like fiat entry and fiat entry and fiat exit. Still depends on a lot of different companies that is, let's say, is not allowing stablecoins to thrive in a way that it should, because the profit motive is already there when we don't yet have enough distribution, so to speak, right? And but again, like with all of these, stablecoin is an extremely new infrastructure, and we are only starting to see regulations like the Genius Act, like what MiCA is doing, what Hong Kong, Singapore, Dubai, countries like these are doing. And even with all of these and with all this, how should I put it, limitations, we are already seeing corridors like Latin America, Africa, in the MENA regions, where billions and billions of dollars of transactions are flying in through remittances, through vendor payments, through freelancers doing, and the gig economy.
Gig workers.
All of these transactions are a clear, not only just a proof of concept, but it's only the first flood of what's going to be trillions of dollars being processed within the stablecoin and the blockchain system, right? However, there are a couple of issues that we need to solve. I want to mention two of them specifically. One is you have got multilateral netting, and you have got the other one is the CLS system. We need some kind of.
What does netting imply?
So netting is actually a pretty cool thing that I want to give props to the traditional banking infrastructure, that they have figured it out, and they do it quite well actually. It's a process that increases capital efficiency of banks tremendously. So what does it mean exactly? So there are two types of transactions. So there are two types of netting. One is bilateral and multilateral. Bilateral will be, let's say, Bank A owes Bank B $100 million, and Bank B owes Bank A $90 million. So both banks settle at the difference of.
They will offset it.
Yes, exactly. You offset it. Like bank A doesn't pay bank B 100 million, and then they send
Right.
90 million. That doesn't happen, right?
Mm.
Now again, so what it makes it easier, it makes it easier for the banks to operate at a much more capital efficient manner, right? They don't have to pay hundreds of millions of dollars every day and then a few hours later receive a similar amount back.
Right.
It's a tremendously cost intensive. So what multilateral netting does is it solves an even bigger problem, which is, let's say, five banks owe each other something around 100 or 200 million dollars. So does that mean every single bank has to hold that amount of cash in their book for that day? Multilateral netting solves this problem. So what they will do is they will figure it out how to settle this debts in the most efficient manner possible. So if bank A has to pay, let's say, 500 million, bank B has an obligation for 400 million, bank C has 600 million. So the total amount goes to 1.5 billion dollars. Now what bank like multilateral netting will do is they will see, okay, what is the actual obligation here, like who has to pay whom how much, and it figures it out, as I said in the previous example. So it's actually that the total obligation was $10 million that bank A owed to bank B, and that's exactly what multilateral netting does with multiple banks, 4, 5, 6 banks at a time. So instead of moving $1.5 billion gross, you only move something like $100 million of actual settlement money
Mm.
that needs to change hands. So it's like a 93 to 96% reductions in capital in liquidity requirement, and that's what makes this system so efficient. And actually, the good news is there are projects, stablecoin projects like PayGrid, that are working on multilateral nettings and PVP, which is to reduce the Herstatt risk. You have the
Mm.
payment risks. So I'm hopeful that in the coming next couple of years we are going to see essentially comprehensive infrastructure that does everything from and everything end to end and settles as much as possible on the blockchain. But does that mean that we are going to completely do away with the banking infrastructure? That's not going to be the case. Stablecoins are obviously fast, robust, and efficient, but it only lives in the blockchain, and we cannot solve issues
Right.
in the on ramp and off ramp status with the blockchain. So stablecoins isn't going to exactly eliminate banking. It's just going to become the most important part of what international banking is today. Because once you see how the speed of blockchain settlement, then it becomes extremely easy for banks to decide, okay, oh, we are not going to be using this antiquated correspondent banking system anymore. We are just going to go from, like, we have the wallet of this bank here, and we need to pay this bank directly, so we just send it using a blockchain, whatever blockchain that you want to use, right? Effectively, that's where we are. It's the moment banks realize that stablecoins are a much more efficient mean of transaction, which they are
Mm.
obviously already doing. Once like one after another bank is onboarding, doing some sort of a pilot with stablecoins just to understand how they can understand it and how they can
And
best
how they
use.
can like integrate it into the
Yeah,
system.
yeah, exactly, and obviously how they can make money out of it, right? So that's the biggest hesitation right now, that they're assisting, like they're seeing their biggest money making infrastructure is being threatened by this new stablecoin thing, and they don't really understand how exactly they can make more money, or at least the same amount of money that they're making from banking. So that's what the worry is, right? But again, more and more banks are obviously integrating, and I am bullish for the future. Truly believe that within the next 2 years, we are going to see banks like JP Morgan, Goldman Sachs, Morgan Stanley doing at least a few hundred billions in transactions and settlements across the globe. I mean, obviously, like, I think JP Morgan already has its own blockchain. I think Goldman Sachs are already doing something, but again, they are in a very much of a pilot phase. But yeah, the correspondent banking system is so fragile, it's so brittle, that it's for stablecoin, it's not even a challenge. The moment you see a stablecoin transaction is the moment you get convinced that either stablecoin is the biggest thing that happened in the history of financial innovations, or it's going to kill your livelihood. The multi-billion dollar banking business that you have, it's threatening that. So either you become extremely receptive to stablecoins, or you become extremely defensive, that I have to stop the innovation
Right.
however I can, right? And we all know how whoever tries to stop innovation actually gets crushed by it, and they go out of business the next day, right?
If you can't beat them, join them.
Yeah, exactly. That should be the mantra of in the business world and in the entrepreneurial world, and that's what it is till it's not. And when it stops being when it stops being the guiding mantra of your business, then you go out of business. And that's pretty much it. And yeah, that's my breakdown of how the Swift system is awesome.